Hi, welcome back to Sugar Mama TV. Now, everyone is going nuts asking me for more videos on investing, and because there is so much information, there is no way that I can do one video just on investing. There's so much information, and I don't want to overwhelm or confuse anyone. So I'm going to continue to break up all this information into bite-sized pieces so that you understand everything and you really build your level of knowledge and information about investing and can make, I guess, more educated and informed decisions for yourself. So bear with me. More and more videos will be coming. I'll be dropping more and more videos over the next couple of months, but I just want to make sure I build a really good solid foundation of information for you first. So this video is it's not all, it's a little bit about the Australian share market and what shares are. So if you are a shareholder, which means you bought some shares in a company, you are essentially a part business owner. So say, for example, I buy some shares in company XYZ. That means I own a percentage of company XYZ. And the more shares I own, the bigger the percentage of the business I own. Now, when it comes to investing in shares, you need to always remember that they are a very long-term investment. Shares, because they're traded on and the value of them can be tracked at any minute or any second of the day, the value of them seems to sort of bounce around quite dramatically, minute to minute, hour by hour, every single day. So, and that means there's a lot of what we call volatility, which is the share price bouncing around. Long term, on average, the share price goes up, depending on the quality of the company. But you can never buy shares, or you should never buy shares looking to make a quick dollar. Generally speaking, they're a long-term investment. And I'll be doing lots of videos on the sort of risk versus return and showing you historical returns. But for the time being, I just want you to understand, if you're going to buy shares, you need to think about holding on to them for at least 10 years. Now, when you buy shares, depending on the company that you buy into, they normally pay what we call dividends, and that essentially is kind of like rent that you would receive on an investment property. You receive dividends from shares, and they're normally paid twice a year, instead of with rent from a property that's paid every month. So with property, you'll get like X dollars per month, whereas with shares, you get two dividend payments, which cover for the previous 6 months. When I'm buying shares, and Australian shares are my absolute favourite investment, and it's probably the key thing that makes up my personal investment portfolio. When I'm buying shares, I'm not really worried too much about the capital growth. I'm looking at buying long-term investment income streams. That's my key focus. And I'm going to show you how the Australian share market is built up and how dividends, which is my rental income from shares, builds up over time and how powerful it is. So looking at the Australian share market, it's broken up into really 3 different groups. The first group are, and we call those groups indices. So the first group is the industrials, and companies that make goods and services in what we call industrial companies. So for example, supermarkets, drink manufacturers, transport companies, they're industrial stock companies. The second group is resources. So that normally involves any company that takes something out of the ground. So mining of like oil or coal or gas or even diamonds. So they're resource-based companies. And then the third indice is actually a sort of a mix of the two, of the industrials and the resource companies combined. So essentially we've got 3 different groups. Now, the table I'm going to show you right now shows the performance of $100,000 invested in 1979 and what it would be worth in 2014, so essentially 6 months ago. As you can see, the industrials has performed a lot better than the resources or the odds. Now, if I'm looking to get my money to work as efficiently as possible for me, even with the volatility, I want to be riding the industrial wave line. My money is going to be growing over a long-term basis a lot more efficiently if my portfolio is only industrials. Now, as I said before, these companies pay dividends, and one of the great things about owning shares is with the dividends, a lot of companies, not all of them, allow you to actually reinvest the dividends. So say, for example, I receive a dividend check of $500 from some shares that I own. And because I'm working full time on a salary, that $500 I don't need that $500. I want to, really focus on growing my portfolio and growing my financial independence. I can choose with most companies to reinvest that $500. And it's called an automatic dividend reinvestment plan, which I'll show you how to set up with shares. So what happens is that $500, instead of being deposited into my bank account, it actually goes back into my share portfolio pool and automatically buys me more units. So it essentially increases my percentage of ownership in that business. Now, over the long run, using a dividend reinvestment plan is a really powerful way to organically grow your share portfolio and financial wealth over the long run. And when you look at industrial stocks, they typically tend to pay a really strong dividend, and some of them come with really good tax credits. And if you can try and set it up so that over the long run, your dividends, you don't take those dividends, you reinvest them, the portfolio growth is actually spectacular. So this table that I'm showing you now is that exactly the same period of time and exactly the same initial starting capital of $100,000. And as you can see, with the industrial shares, that $100,000 is now worth over $9 million over the 35-year period. So the point of this video is to make sure that if you want to look at using shares as the foundation of building your financial wealth and independence, you can't look at shares as just a one-dimensional asset. They are two-dimensional in that they provide capital growth and they provide income. And the income is probably the most valuable component of your share portfolio, because that is what's going to provide you with your passive income, which is hopefully going to pay for your retirement and hopefully an early retirement, or fund your lifestyle and living expenses. And if you can, while you're building up your share portfolio, reinvest those dividends, so forego those dividends to help increase your ownership in those companies, it's a very, very powerful way of organically growing your portfolio over the long run. Now, one thing I'm just going to touch on before I end this video is with shares, I always recommend you understand the investment before you actually buy into the company. And the second most important point is you never put all your eggs in one basket. You always diversify your portfolio. So when I look at my share portfolio, I don't have all my money sitting with one company. It's spread across numerous companies and numerous industries. But predominantly they are industrial companies, so good companies in Australia that provide goods and services. And they've been operating for a long time, and they're multi-billion-dollar companies that have been paying consistent dividends, which have increased conservatively over time, and have just, I guess, again, offer those dividends and offer dividend reinvestment programs from time to time. So I will be showing you the portfolio that we're growing through the Passive Income Project through the website sugarmama.tv. But for the time being, this is just I guess a 101 on the Australian share market, and we're going to build your knowledge from this point forward. So ciao for now, and I'll see you in my next video shortly. Okay, bye.